To remain updated with the latest business news, click on the bell icon.
Goldman Sachs has cut 2022 FPI flow projections for India by over 80% to $5 billion from $30 billion estimated earlier, out of over $40 billion inflow that we have seen in the last 3 years of 2019 to 2021. Nearly $14 billion has left in the first quarter of 2022, and the impact of which we have clearly seen in the markets, with Nifty touching the level of 16,000. Despite the good inflows from the DIIs, FPI equity assets stood at 45.5 trillion rupees as of the end of Feb 2022, which translates into 18% holding of aggregate listed Indian equities. So they still hold a good grip over the Indian equities. Amongst emerging markets, if we see, India has remained a bright spot for foreign investors, and if we study the correlation between the FPI and the equity markets, it has largely been a positive one, especially for a long time span, which is not the case with DIIs, as the mutual fund flow still are not seen as reliable driver of capital markets as the FPIs have been. So high crude prices, high interest rates, high inflation, and the current geopolitical turmoil that we are going through is expected to create a significant balance of payment deficit in 2022 for India. Drop in overall capital account surplus will lead to downward revision of GDP estimates for 2022, which we have already seen by some of the rating agencies and the top broking houses. So the kind of impact that FPI's absence from the Indian equity markets would be seen clearly on the financial services sector. The kind of returns that we saw in the sector from for last 3 years could not see a repeat of it happening. The maximum holding of FPIs is in financial services sector, followed by software, oil and gas, automobile and auto components, followed by pharmaceuticals and the personal care and household products. So net, the three more major sectors that would be impacted by the FPI's absence or being less active in the markets would be financial services, software, oil and gas, automotive and auto components as such. But the higher raw material prices, the higher commodity prices that are estimated to stay at elevated levels for some more time are going to impact margins of some of the sectors where the fuel cost would be a concern. For example, the paint sector can see the pressure on the margins. Your FMCG companies would see pressure on the margins as the agri-commodity prices and palm oil, which is the major input for FMCG companies, is seeing a spike in price internationally. So absence of FPI is seen as a negative for the Indian markets, but what is the kind of impact that it would have, going forward if the current situation prevails for longer? That is to be seen.
If you like the video, do like, comment, share and subscribe.